Welcome to video 15B on tax classification and the check the box rules. So we've talked a lot about classification in the modules leading up to this, and we've talked about this idea of a flow-through entity versus what we're now going to call a non-flow-through entity. So flow-through entities are things like partnerships, LLCs, sole proprietorships, limited partnerships, S corporations. Those are all flow-through entities. The primary non-flow-through entity is a corporation. So income generated by a flow-through entity is taxed only once, while income of a non-flow-through is taxed twice. So a non-flow-through is taxed first at the entity level and then at the owner level. Flow-through entity owners, on the other hand, pay tax on their share of the income as if it had been earned by them. So it's just reported straight through on their own individual tax returns. So here's a blurb from the book that talks about the number of different types of entities. And you can see that, for example, a C corporation, the number of entities represented by C corporations is just over 5.5%. But the gross receipts represented by C corporations is almost 61.5%. And the net income from that little 5.5% is nearly 22% of all net income that's reported. S corporations, a little less skewed, about 13% of the entities are S corps. They're about 20% of receipts and about 17% of the net income. Everything else is pretty consistent until you get down to sole proprietorships. So you can see that the sole proprietorship is far and away the most popular form of business entity, with almost 72% of all entities are sole proprietorships. However, they only represent about 4% of business receipts and only about 15% of reported net income. So how does income transfer from an entity to an owner in a flow-through entity? Well, that happens through the allocation of income at the end of the entity's tax year. So Hogwarts Partnership has two partners, Albus and Dumbledore. Both of them have a 50% interest. And just for the sake of convenience, Hogwarts is a calendar year-end partnership. Hogwarts generates taxable income of $100 in 2018. Albus and Dumbledore are both required to recognize $50 of income that passes through or flows through from Hogwarts to them in 2018, the year in which Hogwarts generated it. So Hogwarts generates taxable income of $100 again in 2019, and this time it also distributes cash of $79 to each partner. Albus and Dumbledore will both recognize the same $50 of income. That's it, done, period. That cash has no effect. Cash, the distribution of cash and the allocation of income simply are not the same in a flow-through entity. Income is allocated whether the cash is or not. Let's contrast that to a non-flow-through. So how does income transfer from entity to owner in a non-flow-through? That occurs through distributions that are made anytime during the year. So Hogwarts Corp has two shareholders, Albus and Dumbledore. Both own 50% of the outstanding shares. Hogwarts is, again, for convenience sake, a calendar year-end corporation. Hogwarts has taxable income of $100 in 2018. Now, since this is a non-flow-through entity, it has its own tax that it pays at 21%, leaving $79 of after-tax income. In 2018, Albus and Dumbledore will recognize no income because this is a non-flow-through entity. In 2019, Hogwarts generates a taxable income again of $100 and distributes cash of $79 to each shareholder. Now Albus and Dumbledore will both recognize the $79 of income. Done, period. Ownership in a corporation does not give you entitlement to a share of that corporation's income each year. Instead, you have to wait until it is distributed to you. So in this case, cash and the allocation of income do occur at the same time. Income will not be allocated in a non-flow-through entity unless cash or some other property is actually distributed. Okay. So, the thing about these non-flow-through entities like corporations is that means some or all of the after-tax earnings can be retained. And if you think all the way back to Module 1, we did some examples of this. So individual shareholders, what happens to them is if the corporation continues to retain the earnings that it's generating, then in theory the share value increases when after-tax earnings are retained. So that think of it as if all they did was take the cash and just leave it in a bank account, then obviously the value of your shares would continue to go up because the value of that bank account continues to go up. So when you sell those shares, you would generate capital gains. Capital gains can be taxed at 0, 15, or 20%. There's also a 3.8% net investment income. I'm not going to hold you responsible for that. That's an individual thing only, but just so that you know it's out there. And as a result, taxes on the capital gain could be discounted to reflect their present value. So think of this as the idea of, look, I have no control over whether Cheesecake Factory declares a distribution to me as a shareholder. But if I'm the 100% owner of my own corporation, then I have nothing but control over when that corporation might distribute to me cash. I might leave it in the corporation, have it build up in value, and then ultimately sell the shares 5 years later, 10 years later, 20 years later. In which case, obviously, the capital gains tax that I'm going to have to pay 20 years from now needs to be present value back to today's dollars to compare it to the tax on a flow-through. So one of the ways that the tax code defeats me from just leaving my earnings inside of the corporation and having them build up with only the entity level tax is through two tax forms. One is called the personal holding company tax, and the other is the accumulated earnings tax. And what happens is both of those are designed to prevent a corporation from unnecessarily retaining any earnings and therefore distributing cash that it does not need. Now, those two taxes are a little bit beyond the scope of this course, but they are out there. So what about if your entity generates losses, right? So we've dealt with an income generating entity. What about a loss generating entity? Well, a C corporation has an NOL, and it can, in the 2018 rules, carry it forward indefinitely. And don't worry, we're going to cover this later in the corporate chapters. And under the 2017 and prior, you used to be able to carry that loss back 2 years or forward 20 years. And currently, the law limits your NOL to 80% of the current year's taxable income. And again, don't worry if don't need to worry about getting caught up in how NOLs work yet. We'll cover that in a couple chapters. So losses from C corporations, just like the income isn't available to me as a shareholder, that loss is also not available to me as a shareholder. So if I happen to invest in a company and it loses money, that really does nothing for me currently. It might lower the value of my stock, but that's because it's legitimately lowering the value of my stock. Whereas losses generated through a flow-through entity are available to offset my personal income, so the owner's personal income. But of course, we know that that can be subject to restrictions. For example, the basis, at-risk, and passive loss limitations. So the ability to deduct flow-through losses against other sources of income is a significant issue for a new business because most startup businesses lose money. And as a result, having to wait, generate NOLs, and then ultimately have to wait to recognize those NOLs in a later period may be a less efficient tax strategy than establishing yourself as a startup originally, and therefore those losses flow through to you as an owner. Okay, so let's assume that Cho's going to organize the Leaky Cauldron, or TLC, as a C Corp, and that in spite of Cho's best efforts as CEO of the company, TLC reports a tax loss of $50,000 in its first year of operation. So just for the sake of simplicity, assume Cho's tax rate is a flat 35%. She's going to have ordinary taxable income of $200,000 from her husband's salary in year one. So how much tax will TLC, the corporation, pay in year one? And how much tax will Cho and her husband pay on the $200,000 of other taxable income if TLC is organized, as we've listed here, a C corporation. Well, TLC as a C corporation generated a loss, so it won't pay anything in taxes. It's brand new, so there's no carryback available. It will be able to carry it forward, but in year one, it pays no tax. Because Cho cannot use any of that TLC loss to offset her other income, she pays $70,000 in taxes, which is her husband's $200,000 salary times, that should read 35%, not 33%. Right up here should be 35. Okay. So let's suppose instead that Cho organizes TLC as an S corporation, recalling that an S corporation is in fact a flow-through entity. And the year one loss for TLC is $100,000. Sorry, Cho's basis is $100,000. Its loss remains $50,000. And that basis issue will become more important to us in a few chapters, but just know that we have to have it right now. So how much tax will TLC pay in year one? How much tax will Cho and her husband pay on the $200,000 of income? Well, because this is a flow-through entity, recall that the S corporation itself pays no taxes. It's simply not a tax-paying entity. Cho gets to deduct currently that loss, assuming it flows through and it's not limited. So it's not limited by basis. It's not limited by at risk. She's a material participant, so there's no passive loss limitation. So what happens is that reduces her taxes from $70,000 to $52,500. So her savings is that $50,000 flow through times 35%, or $17,500. And notice that we didn't do a rate reduction like we've done in some of these previous examples due to the QBI deduction, because the QBI deduction does not apply to losses. So you don't get that 20% deduction against your losses. Okay, so suppose TLC is organized as an S Corp, and Cho's basis before the $50,000 loss is $100,000. And let's further assume that she does not participate in the business activities, that she's a passive investor. We should already be thinking the second I hear she's not a material participant, that there's probably going to be a passive loss issue. So again, how much tax will they pay? Well, in this case, it's just like it's a C corporation. Because she's a passive investor, the passive income limitation, or the passive loss limitation, applies to Cho. She won't be able to deduct any of that $50,000 unless, of course, she generates some other form of passive income. Okay, so there are a number of other entity tax characteristics that are discussed in some vague and ambiguous circumstances in Chapter 15, but I've listed them here largely because they're going to reappear. We're going to see these items again as we march through the following chapters, right? So we're going to do Chapter 16, we're going to do Chapter 18, 19, 20, and I guess 22. That sounds right to me. So maybe a little bit of 21. So we're going to cover these items in detail as we go through those chapters. It makes sense for you to read this Chapter 15 to understand the basics of the tax characteristics of these entities, knowing that in the future we're going to dive into them much deeper. All right, so let's talk about entity tax classification. So how is it you decide what's a flow-through, and how is it you decide what is a non-flow-through? So it used to be that taxpayers and their lawyers would cook up all these crazy types of entities, all these weird hybrid entities that they would want to be treated one way and not be treated another way. And finally, a couple decades ago, the IRS actually threw up their hands and said, you know what? We're just going to let you decide what you want to be. You're going to check the box, choosing whether you're a flow-through or a non-flow-through. And once you've decided, that's fine. Go ahead and decide. Now, we're going to make it tough for you to change, but we're just going to let you make that initial decision and let you stick with it. But there are some restrictions. So, for example, a corporation has to be a C corporation unless it makes an S election. So a C corporation cannot check the box to be a flow-through entity. It can, however, make the S election to treat itself as a flow-through entity. And again, we'll talk about that more when we march through, I believe, Chapter 22. Unincorporated entities, so that's anything but a corporation, can basically check the box on whatever entity type it wants. So typically, they're going to be taxed as partnerships. So if they have more than one owner, of course it can't be a sole proprietorship, but they could elect to be treated as a corporation. So you can establish a partnership and you can in fact elect to treat that as a corporation. Now, I'm not sure why you would do that, but you could. So if they only have one owner, then they're generally taxed as a sole proprietorship. And that's true even if it's set up as an LLC, right? So partnerships by definition are required to have more than one owner, but an LLC can have one owner. If that LLC is owned by one individual, then from a tax perspective, it's treated as a sole proprietorship, and it actually files on sole proprietorship, a Schedule C. If it's owned by an entity, so for example, what if a corporation owns an LLC, then they actually disregard that entity. It's as if it doesn't exist. Now, legally it does, but from a tax perspective, it's treated as if it doesn't exist, and whatever its income is just flows through onto the books and records of the entity. So unincorporated entities, as I've mentioned, can simply elect to be taxed as a C corporation, and if they do, they can then elect to be taxed as an S corporation. Okay, so this is a nice chart from the textbook that kind of discusses the decision tree for the check the box regulations. I encourage you to take a look. That brings us to the end of video 15B on tax characteristics and the check the box regulations. Thanks for watching.
I have never seen or read Harry Potter.
I just never got on board, you know what I mean?
I don't read fantasy books.
The social world has pushed Harry Potter intellect onto me against my will.
Based on what you know, tell me what you think the story of Harry Potter is.
Okay, I think Harry Potter is a poor kid who lives in London, and then one day a monster comes into his room and then puts a Z on his forehead with a stick.
An owl flies to his house and tells him that he's gonna be a witch.
Him and his friend Jacob and Hermione, they left and they went to Hogwarts.
They get to magic school in a wagon or something. They get clubbed over the head, put in a wagon.
And then they met Gandalf, the wizard, the master wizard.
There's a really smart house, there's a cute house, there's an evil house, and then there's like a just house of people that are generally kind.
And there he trains with all of his friends to beat the guy, Ghost, the monster who gave him the Z on the forehead.
He plays Quidditch, which is a stick game where you hit a pigeon with sticks in between two goals that go like this.
Harry Potter and Hermione fall in love during all of this because she's like the sweet, smart, feisty one, and he's like needs her around to like get through his life.
They wear capes. Some of those capes are adorned with patroni. There's a patronus.
Ooh, someone's a werewolf at one point, right? One of the teachers is a werewolf, maybe?
And then Voldemort killed Harry Potter because he was being too nosy. It was in this golden room where it was Voldemort and there was like a bowl of water and it was talking.
And he has this big fight with him at the end.
Nostril Man like dies. I feel like he like falls off some sort of cliff or something.
Hermione put the wand in the golden goblet. There's powder in there. Boom! By the face of her friends, killed Voldemort.
And then Harry Potter was wounded in the fight but didn't let you know. And then he dies while Hermione is crying over him, and it's really dramatic. Yay!
And that's Harry Potter.